Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, February 22nd, 2021. This is the first trading day of the week. Of course, markets were closed yesterday for the holiday and picked up or resumed trading this morning. So we'll take a look here. Let's look at the indexes real quick. Brief update. I did get some charts out to you this morning. And then I'll update some of the other recently highlighted trade ideas, such as gold and silver. Definitely want to do an update there. Um, and maybe a handful of the miscellaneous trade ideas that I've talked on lately as well. So mainly just kind of an update on the markets because that's probably, well, without a doubt, one of the most important thing right now in the equity markets. If they crack, there's some pretty aggressive downside targets that I still maintain. I'll talk on that. Did see a question yesterday that, well, I caught it today, asking, hey, all right, great so far on the shorts. When do we cover? Well, first of all, here's where we're at. Let's not get ahead of ourselves. I'm starting the video out to reiterate those targets and where I think we're going. You know me, I don't mix words. I'll tell you where I think we're going, then I'll tell you what it'll take to get there. We still need to get to my targets, which are conditional, if you will. We still have to take out that major support, which was the first target. This is a weekly chart. And I know you can't see it in the video. I'm just trying to show you that I have two trend lines. One is generated off the lows back in 2000, late '08 in the NASDAQ, early March of 2009 for all the other indexes. And then I also have an alternative trend line right here. And they both come in roughly together. So now I'm going to zoom in real tight. So in a nutshell, again, I think we're probably headed back down. And again, it's conditional. We need to break support, and then you break support. If the next wave down comes and we're going towards my second target, which I think will be hit, then I think it sharply increases the odds that we'll go on not just to hit that second target, but I'll go all the way down here. And again, you can see the trend lines. There's trend line 1, trend line 2, and then that fourth target also is it's really a there it's called a target zone because you have multiple support levels together. But roughly I'm looking at a back test of the what I call the pre-COVID highs where we peaked in February of 2020. I think that's a likely area because again you had the trend lines coming in around the same area, and price that's a major reaction high as well. And that's where I think we're going. And of course, I will give you my thoughts as to where to cover. That's up to you. You want to book, you can book profits here, and you had the best shorting up in at least a couple of years. And but I do think there's more, and I'll certainly update if and as we approach T2 to give you my thoughts on whether or not a bounce is likely, and if so, how much of a bounce. But again, my expectation is if I am right, and again, it's one thing to call where we're going. These are the next, the additional targets, but how we're going to get there. And the how is, again, the hardest part, but I think it'll be a pretty swift move down. And again, that's based on where we are with everything, with those bear flags on the weekly breaking down. It should happen this week, I believe. At least a good part of that move. And again, these are the weekly bear flags right there. There's your flagpole. We broke down now 2 weeks ago. This is last week's candle. This is this week. We're only on day one of the trading week. Again, today's the first day. But so far, a pretty impulsive move down, and that would project us down to that 299-ish target. You can call it 300. So here's the thing. I would put very good odds that we'll have a reaction off that level. And a reaction could be a consolidation there or a bounce. So one thing to do, you could set a buy to cover order on your short trades, or if you're trading one of the inverse ETFs, you could certainly have a sell order there. You'll just have to correlate it, or just watch when we get down there, and you can do that and take the quick buck. You can also lower stops if you get to T2 in case we smash right on through, because again, when we get down there, a lot's going to happen. And again, one thing I like to do is tell you not just where I think we're going, but how we're going to get there. And I've made these calls before. If that starts to happen, we start to head down here, you're going to see capitulation selling, panic on longs. And remember, the vast majority of market participants are bullish and long at all points in time. Even now, when short interest and short bearish bets have been starting to spike up lately, which always happens after correction. You still have the vast majority of market participants are long, so they're going to panic, take profits. But more so, what happens is the big boys, the institutions, hedge funds, pension plans, in particular, they have to plug the leaks. They can't use the old what we call hope and pray, or buy and hope or hold and pray strategy that the retail investor often does during corrections and bear markets. Retail traders bury their head in the sand and hope that it just stops, and institutions, they just can't afford to do that. There are people that will get fired for just riding out staying heavily long equities, an overweighted equities position throughout let's say 30, 40, 50 plus percent bear market. And last couple bear markets in the Nasdaq 100 were over 50%. So I'm referring to the 2007 to 2009 drop, about 55% or so, 56, and then of course the big drop back in 2000. And so what happens is all of a sudden the risk models start just going out of whack. Delta hedging no longer works. Delta hedging, works great in a bull trend. It means you're long XYZ. Let's say you're long QQQ, and so what you do is you buy puts on QQQ to protect your downside. Well, hey, that works great in a rising market. Why does it work great? Because puts are cheap. The VIX is down low. At the low end of its range. When you're in a bull trend, volatility is low and puts are cheap. But guess what happens when you start to get down here? Maybe they did have funds that were delta hedged, were protected up to a certain point. But guess what? Over time, we've been rolling over. Those puts expire, so it washes out the hedge. They got to roll them. And it gets to a point when the VIX starts spiking, it's no longer cost effective to buy puts to hedge long positions. And then delta hedging stops working. So what do they got to do? They have to start selling, reducing their long holdings. That's where you get those waterfall drops. And again, I know it's a, well, I'm talking about it back here weeks and even months ago. And at this point, it's maybe a little bit less of a contrarian call. I'm sure there's others jumping on the bearish bandwagon. I really don't follow many others out there, but that's where I think we're going. And here we're right there. Remember, we already hit my first target on the weekly chart here. We bounced, had a little brief overshoot, and you could see the same thing with T2. And again, I'll give you my thoughts if and when we get there. But if you're going for the prize, you want to hit instead of hitting, so far we've definitely hit a single or double, shorting here. Most of our initial short entries were there, and then along the way, on just about all the bounces, I'll give you objective short entries or add-ons. And now, so the next one will really come. We take out the recent lows. That'll be an objective short entry, and maybe the last one for a while, because we probably start moving down pretty swift at that point, and then you'll be in no man's land. And no man's land is what I refer to as when the security is smack between resistance and support. And at that point, I don't like to take positions long or short, because if you short, maybe you kick back and back test. I like to short, close to resistance if it's a bounce back. Or right after a break of support, because then you can put your stops not too far on the other side and run a pretty tight an objective stop, not a random stop. I hope that makes sense. I like to use strategically placed stops on long and short positions. That means above or around, a little bit of below or above support and resistance levels, instead of just a random 3, 5, 8%, whatever it is, stop loss in the middle of nowhere, because you're likely to have that stop clipped. Okay, so we'll wait and see if we take out. There's the low from the I think it was the 22nd. We'll have to go to the daily chart to see that there. Yeah, that was the low right there. 24th, I'm sorry. And we're getting close there now. We tested it in pre-market. Remember, the futures just recently tested it. So I don't want to harp on too much of what I covered today. There's potential but unconfirmed divergence. That's just my term that I made up when PPO and the RSI, especially the PPO, because you have the lines that cross. That right now there's a bearish cross in play. You'd have to turn back up, make a bullish crossover to confirm the divergence. Plus, on the daily time frame, with not counting the pre-market trades, we haven't yet equaled or exceeded that previous low on QQQ. So at least on the regular session trades, especially considering we had the holiday yesterday, I'd take that divergence right now with a grain of salt. But it's worth mentioning. Sometimes you get the bullish divergence on the using the pre-market session trades and the ETFs or the indexes, and then and on the futures. You can see on SPY we did not yet take it down, but we're broken below that triangle, and again that was the first target on the SPY daily, 424.45. So we need to take out those lows, and you still have the next target on the SPY is about 394.50, which is also the measured target of the bear flag. There's our flag right there. So right now it's looking good. We're below the 40-week moving averages, simple and exponential, everything that I've gone over. I don't want to just, if I sit here and rehash everything that's happened in this video, will take forever. I just wanted to say we're close, but it is anybody's game. Like I like to say, support is support until unless broken. So there's your recent lows all the way down here on the S&P 500 or SPY. And let's look at the futures real quick, even though I covered that this morning. This is that. I gave you a few different variations. I gave you a longer term 2-hour candlestick chart on the NQs that goes back 6 months. And that one, just like the 60-minute chart, we have positive divergence. And we had it confirmed there, and gave you this minor trend line this morning. So far that's what we got rejected on. You can see it there if I pull a nice and tight. Perfect rejection, and another great example of how trade on the time frame that you're trading. If you were trading off that 120-minute chart, well, guess what? You could have shorted that bounce in the minor trend line. You still can, because we're just a hair below it, with a stop somewhat above. But if you use a candlestick close on the period you're trading, this is a 120-minute chart. That line, that move through there was on an intra-period, only to see a rejection, a quick reversal, and the candle closed perfectly right back below the trend line. Again, I think you can see it there on the video, a doji stick, and so far a rejection. So I like that. That's a false breakout, at least to those that jumped the gun on it and didn't wait for that solid 120-minute close above. It's just basically another rejection off this downtrend, and now we have 1, 2, 3 distinct reactions there. And I also gave you the 60-minute chart of NQ this morning, and that's what it looks like there. Same kind of thing. You can see the minor downtrend line. You can also come off that one there. That might have been the one I was using on the 120-minute chart. But you can see there's that positive or bullish divergence. We basically tested the lows, made a marginal new low, which made it a divergent low, and you have to respect these. I do. These 60-minute divergent lows on the futures, especially if you get them in the indexes, and that's what's lacking right now. Again, the major ETFs, at least in the regular session. We had them in the pre-market session. You don't always have to have that, but it's historically, for a couple years now, this has been the catalyst for the move to the next highs when we got that 60-minute divergences. I pointed them out many times over the last couple of years, and they proved to be the ends of most of the corrections. So now on the flip side, shared in my thoughts where we're going. Even if we kind of muddle the charts here and trade around for a while, I still think we go lower. But here's the point: whether it happens this week or not, if these divergences, again, this is 60-minute bullish divergence on both indicators, RSI and PPO. If it fails to play out for a significant rally, what would significant be? Well, I'd say at least up to here based on the scope of that divergence, 15,536. If it fails to do that, and especially if the divergences are burned through or negated. What I mean by that? Well, you have divergences consist of higher lows in the indicators with lower lows in prices as positive or bullish divergence. So if these indicators turn down and they take out these previous lows, you no longer have the divergence. That's very bearish to see that happen. So, takeaway right now, well, again, you're sitting on support. So, if you're already short and you've been short, nothing wrong with sitting tight. With appropriate stops in place. Your cost is going to be different from the guy or gal next to you, especially if you've been scaling in or micro trading these levels, adding, gaming the short-term bounces, or, scaling into shorts on pushbacks into resistance. And you also need to define your trading style and what time frame it is. In other words, a more active trader is going to spend more time focused on the developments on these 60-minute charts. All the way down, I'll post 5-minute charts. Sometimes I even trade off the 1-minute charts. Whereas a typical swing trader, should really focus on those weekly charts that I started out with. And there's nothing anytime soon right now that's going to change on the weekly chart that will change the longer term outlook of my bearish outlook. Come later this week, come Thursday, Friday, get a big rally, and something happens significant on the weekly chart, or it looks like it may happen. Again, the weekly chart won't be finalized, the weekly candlestick, until Friday 4 p.m. I will certainly share my thoughts. As of now, you guys know my preference is to see whether it's a small rally, like I said this morning, maybe you get a little bounce. There's plenty of resistance levels to contend with. And the way it works, it's simple like this. Again, there are no certainties in trading. There's only probabilities, and because anything's possible. So I view everything in probabilities. Right now we have a downtrend. I'm circling on, again, we're on a 30-minute chart, so we're going back all the way to right here. Well, really, this was the high in the NASDAQ 100, happened back in November. And since then, you can see we've been making a series of lower highs, including this one, and now today's high, reaction high. Let's just circle that one, right? And we've also been making, since then, lower lows, including this low that happened yesterday. Globex, futures had a brief trading period yesterday. They shut down, I think it was 1 p.m. Eastern time, and then reopened about, I think it was 6 p.m. last night. And that happened yesterday. But this is kind of the intermediate term, the near term and intermediate trend. It's down. It started, we topped, it was a mostly sideways action until we broke that level, and then it's been clearly down. So now what starts to reduce the probability that we're going to hit my next target on the weekly chart that I started the video out with, that T2? Well, first thing would be to see us pop that previous reaction high right there, and it's also resistance. It's not just that high. There were other reactions there, and that's about 14,640, right? Then this one here, and that's about 15,025, and then that one there, if I remember right, that was probably, I think that was the 61.8 Fibonacci retracement as well right there, which was a key level. It was also an objective shorting op pointed out back then. So those are, we'll call them check marks for the bulls, or X's for the bears, however you want to call it, if and when that happens. But right now, none of that's happened. And then, of course, a big check mark for the bears, bearish case that is going to be a solid breakdown below the recent lows, and an even bigger check mark, in my opinion, if and when these divergences get taken out right there with the on the PPO and RSI on this 30-minute time frame. So that's it. It's a lot of moving parts, but this is not too many. There's a few things there to watch, and again, everything is incremental. There's not one level that I can give you that says if we cross above this level, that's nothing but bullish. We're going to go to new all-time highs in the market, and there are no just like there are no guarantees that if we pop the recent lows that we're going to go lower. The way it works is we could pop it and maybe a second test, or even better for the bulls, that is. The bullish case, and just speaking metaphorically when I say the bulls, bears, I'm talking about buyers and sellers and what the markets are doing. This is a 60-minute chart here on QQQ, or we can look at the daily, it doesn't matter. There's a possibility the actual low was right there, a little bit above. This was the bottom of my first target zone, which we slightly overshot intraday. So you could test it or slightly break it, and again, you could have that divergence still intact. And so this is what I'm trying to say is I think a break of the lows will do the trick and usher in that next wave of selling, but you got to watch out for a reversal. Because that would be pretty darn bullish if you see what we call a bear trap, a false breakdown, especially if they come in, they step it, they reverse it, and then they just keep buying. And again, if that happens, that's where I'll look at those levels, those previous reaction highs. If and as each one that I just showed you on the 60-minute chart's taken out, that's going to give increase the odds that that whipsaw or that bear trap will stick, and that we could get a more substantial rally. And then we'll look at things like the downtrend line on the daily chart, a back test of that uptrend line. All right, so I'm throwing a lot at you, but that's what I watch. And I always say that the charts are dynamic, and so is my analysis. The charts change every day, levels change. We have new support and resistance levels formed, new trend lines, new reaction lows and highs, moving averages taken out, tested, things like that. And so, all right, so I made it clear where I think we're going, and we'll see what happens, and we'll adjust accordingly. And there's SPY, the S&P 500 as well. I've already covered that. There's the potential also for positive divergence if the SPY were to test or even undercut those lows, maybe go down to that next support. There's certainly the potential for uh, positive divergence on the daily chart here. Uh, but like I said, I think there's a dam that's going to break soon, and I think we'll probably have a good move down. And I think on SPY, even though there's some support around 411, I think it's going to take us down here once the lows are taken out to about that 397 level before any meaningful buyers step in. And on my weekly, it's about 395, so we'll call it 395 roughly. And of course, I still favor personally, as far as the index futures I'm pressing are the Nasdaq 100 NQ and the RTY Russell 2000 futures. This was, in my opinion, just a golden shorting op on that back test of that key 209 level and 1 year sideways trading range, super well defined. Impulsive move, bear flag. You were able to short the top of a bear flag, which we've since broken down from. And again, I just want to see red selling today. I want to see a nice solid red candle this week. We've already had two red candles out of the bear flag, and we broke the first one last week. And so far we're following through, and it's everything I want to see, and that's why I'm maintaining, continuing to press the shorts and maintaining these targets. 171 is my target at this point in time for the small caps, and I might add additional targets later, but that's where we're looking now. That's a level. And again, to answer that question of where to cover, I would put very good odds, and I will almost certainly be not only covering but probably reversing my Russell 2000 shorts if and when we get there around that 171 level. I'll also be aligning that with where SPY and QQQ and the NQs, because sometimes those big caps will hit support first. The buyers will step in there, and maybe RTY or the Russell 2000 IWM is a little short of 171, and just all the program buying sets in, and you could reverse there. So you got to be flexible and nimble. If you don't have time to be in front of your computer all day, just set the OCO orders. If you're targeting 171, you probably want to set a buy to cover order a little bit north of that, just to be safe in case the buyers step in early. Or if you think the bottom's about to completely fall out of this market, if you get down towards there, let's say about 175, lower your stops and let it run. Maybe we'll shoot down to that next support there, about 150, almost 159. Okay, enough on that. As always, I hedge my bets. I trade a diversified portfolio, just that same premise with investments. In a 401k or IRA, you don't put all your eggs in one basket. And so gold, I've been harping on gold and just continually long-term bullish, but recognizing for a long time, weeks, probably actually months, that we were in this big symmetrical triangle pattern here on the weekly chart on gold, and that our next long-term buy signal would come on a break of that level, and that especially if we could follow through and break above that 173.87 level, both of which have happened. So that's nothing but check marks for gold as of now. Hey, if it fails, great. If it falls back, I'll look to position on a back test. Anything much more than that, that's not going to be good, especially if you failed the breakout completely and you went back into the triangle. If that happened, you'd probably then break to the downside. But as of now, nothing but check marks for gold. Again, that's a weekly chart there. There's the daily chart, same triangle, broke out, we're running. Silver doing well too. SLV, weekly chart, this is silver ETF. You have a comparable downtrend line, which has now been taken out. There's still that previous reaction high, and this candle's not as impulsive, but we're above it right now, and so I still like gold and silver. And what I really like about them is the fact, and I told you this before, I welcome being wrong on the euro and US dollar analysis. I usually incorporate the analysis of the dollar and the euro, and that's because gold moves inversely to the dollar, and proportionate or directly with the euro. So in other words, euro up, gold up. And now lately it's been stalling around. We put in this divergent low. We did get this thrust, and that helped gold break out. But since then, the euro has been weak, um, and yet gold has continued to rise. And I like that. Again, my bets aren't laid. Personally, I don't have any money betting on the euro or betting on the dollar. I'm betting on gold right now, miners and silver and those miners, and various mining stocks. And the fact that gold or the euro is not rallying and the dollar is not falling lately is uber bullish to me because it shows me an overwhelming demand for gold. The only way gold goes up if the dollar holds steady or rises is that there is an overwhelming demand for gold, meaning a lot more buyers than sellers because it's offsetting the impact of a rising dollar. A rising dollar will cause, if in a vacuum, if supply and demand are perfectly equal, same number of buyers, same number of sellers, a rising dollar will make the price of gold fall because it takes fewer dollars to buy an ounce of gold, and a falling dollar will make gold rise because it takes more dollars to buy an ounce of gold. It's very simple. It's not a magic formula at all. But again, that's where the supply and demand kicks in. So anyways, that's it. I don't want to beat a dead horse. Just let you know I still like the gold trade as of now. Yeah, I said I'd cover a few miscellaneous things I've highlighted recently. On Friday, I pointed out Roku and said that if I were short, I would cover it. It would probably get a bounce because we had a perfect tag of support, both price support, that 171 price support level, and the measured target right here for the bear flag. That's this line right here. There's the flagpole, bear flag. And if you took that trade so far from where we were on Friday's lows, what was right here, about when I covered it, it was good for about a 24% bounce, 22, 23. Maybe we get a backfill, maybe not. Depends. If the market craps out this week, you probably will not see that backfill. If the market can rally here in the next day or so and put a little more upside, yeah, Roku probably backfill that gap. But again, man, if you took it long on that support on Friday for just a quick bounce trade and you got 22%, and the market's sitting on the edge of a cliff, either take the money and run or trail up your stops. That would be my suggestion on that one. The other ones I've mentioned recently were the those education stocks, and some of them took off and exploded. COE, I forget exactly where it was pointed, hit that second target, but reversed. And I made mention too. We had another one. Which one was it? Last week. Let me find it. It was this one here. REDU. That one also took off. The breakout was on the minor trend line there. That was our entry. Hit the first target there for about a 33% gain. Then we went on to take out that trend line yesterday, and so it was an 88% gain from that breakout. But it's just been isolated, and so I believe I made mention last week that I'm not crazy about these anymore because we're seeing a couple pop, but not the majority. And those that are popping, I'm not seeing the volume and the participation in the sector, and so I've cooled off on that sector. Like I said, I'll update those that pop and break, but I'd be cautious right now on those. I'll continue to watch the sector for any developments. There was one, what was it, a couple weeks back, RKLB, I think, and that one was running at first, and then it failed to break out, so I just wanted to do an update and say, there was a breakout. It was long, started a run, made it about halfway to that first target, but then right here, boom, that breakout failed, tried to regain the breakout, and it's going for a back test of the trend line. So bottom line, not good that it's back below the 987 support. That was really where it needed to hold above, and so I just wanted to do an update there on that one. Let me see, what else is there? Oh, yeah, let me do Treasury bonds real quick because I mentioned those looking interesting lately. And they did. ZB, you get more bang for your buck on the long bond. ZB, the 30-year bond. I pointed out here we had, this is a 2-hour candlestick chart, but you'll see this similar thing on the 60-minute chart. Positive AK bullish divergence, and nice lift so far. We hit that first target there, 153, 147, then the second target almost to that, 154, 188, close enough to take some profits there. And this will continue to go up. I think it will. If this is going to mesh with the stock market breaking down this week, more upside in treasuries, whether we take out this minor trend line here or not. But I'm eyeballing this level here, 156, 176 right there. I think that's pretty good resistance, as is 155, 173, possibly more. Let me just queue up the charts of TLT, the ETF for the long bond. So on TLT, you have it falling to really good support here. This is a daily chart, 134.70. It was big support back here. You had multiple reactions right there. You came and tested it back here in 2021, and again right there in 2021, and you just hit it the other day. So and that's it. But on the daily chart here, you're pushing up against downtrend line resistance. Being that we're coming off major support, so this all meshes with the stock market. If the stock market breaks down and has a impulsive drop, you're probably going to see more money coming into treasuries as those same institutions I mentioned earlier today, pension funds, etc., need to reduce their risk exposure. By doing that, they need to sell stocks, and they're going to put that money into safe havens such as treasuries and things like that. And treasuries are really one of the go-to safe haven trades. So you might see that flight to safety risk. So there's your level right there to watch. And then finally, the thing I'm keeping an eye on are these broad-based commodity ETFs like GSG and GCC, and they tell me that there is zero abatement in the inflation trade. We all know this. Actually, let me read a headline because maybe we all don't know this. I got a headline today came in. Home price growth hit record in 2021. Home price growth surged to a record in 2021. Blah 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 blah. The S&P CoreLogic Case-Shiller National Home Price Index rose 18.8% in the year that ended in December, unchanged from the prior month. The calendar year increase was the highest since the index began in 1987. Okay, I don't know where you live, but I'm in South Florida. Our real estate market is literally on fire, and I've read articles now. The rents are even going crazy. Miami's saw an article the other day. It's the most unaffordable market now in the country. And yeah, I know there's areas where people have been moving out of, and maybe the market's not as hot, but overall. And again, it's many factors: shortage of homes, artificially low interest rates, too low for too long. A combination of that, Fed, just keeping the pedal to the metal, in causing this, creating now a bubble. We didn't have a housing bubble before. We have a almost everything bubble now. And somebody asked me, it's everything but commodities. Commodities are, just remember, coming off a bear market. I don't know if I shared that with you guys in the video, but let's not forget, and I've been saying this for a long time, commodities, the stock market was in a bull market for a while. Commodities just ended a bear market when COVID hit back in the final leg down with the stock market in March of 2020, and have only started. This is early stage bull market action. And why do I refer to it as most likely back here, early stage bull market action. And I went from most likely to almost certainly when the primary downtrend line was taken out. That's certainly a sign. When you saw previous reaction lows get taken out, because remember, a downtrend is simply a series of lower lows and lower highs. When you start taking out the previous highs, now you have all the makings of a new uptrend. And so, once again, this is the inflation trade's here to stay. Depending on how aggressive the Fed gets with rate hikes or whatever, there'll be corrections along the way, as there was. You could see already a correction there, but pretty impulsive buying so far. And again, this to me is much more indicative of early stage bull market price action than it is a bear market rally, because again, it's already exceeded so many previous reaction lows and trend lines. And the simple fact, if you just look at it from a pure valuation perspective, if you add up all these commodities, and you can use any commodity index you want, some are more heavily weighted to energy, and others are more balanced with agricultural commodities, you're going to see the same thing. Prices are much lower than they were back in 2010, 2011 when the commodities peaked. And from a relative basis, we have the highest inflation in over 4 decades. And so to to just say that those previous highs are a likely target, I think is an understatement. We'll probably end up taking those out. So again, I just wanted to reiterate that we're probably in an early stage bull market in commodities. There'll certainly be corrections along the way, but the takeaway from this is you've got all these experts out there on Wall Street trying to figure out what the Fed's going to do, how much they're going to hike. Well, let me tell you, this in the housing market, because that's not is what's keeping the Fed up at night, is going to force their hand to be more aggressive. Powell is one of the most dovish Fed chairmen we've ever had, and we've had some pretty darn dovish ones in recent years. But again, his hands are going to be tied because he cannot keep the pedal to the metal. He's going to have to slow down this inflation trade, and the fact that we're heading into the end of February here, and the meetings next month, and here it is. This is a well-diversified commodity ETF, and tracks the Wisdom Tree Continuous Commodity Index Fund, and it just popped into a multi-year high right now today. Okay, so that's it. So, anyways, so it looks like we're certainly gonna see considerable rate hikes. Whether or not they do 50 at the next meeting instead of 25 basis points, I don't know. Still maybe coin toss odds. I haven't checked them. All I know is the rate hikes are coming, and if they do 25, it just increases the odds that they may have to do an intermeeting emergency rate hike. I don't know. I'm just going to speculate on a 50 basis point, but I don't even care. All I know is I'm going to watch this and know that this and the housing market, unless you really see prices start to come down hard, is going to force the Fed's hand. And when the rates go up, the market's not going to like that. Okay, let's just wrap it up here. This is another variation of that 60-minute chart on QQQ. There's our previous low. Remember, any equal, although we did hit it in pre-market, equal or marginally new low will still have some positive divergence, which leads to potential for a rally. I gave you these resistance levels last week. I could update them now. You can see probably the resistance level to watch is roughly today's highs, because we had that previous reaction low from last week, and then we hit it again today about 344.20. So ideally you want to see us stay below that level, but again, there's plenty of room for the Qs to go up. Just watch these previous reaction highs there. If it does, and otherwise if we start to go down, then this is the week. I still think, even though we're close to support, I'm just telling you personally, I'm still pressing the shorts for now, because I don't want to be out of those in a situation, especially, let's just say there's a huge move down in the futures overnight and we get lock limit down. We haven't seen that in a long time, and I don't want to be in that situation where I don't have shorts on the NQ and these stock index futures RTY, because if you don't, and you wake up to that limit and you say, okay, wow, markets are really dropping today, you can't short when it's lock limit down. The circuit breakers coming in, you got to sell. You can only sell in an uptick and that kind of thing. So you could actually be boxed out from shorting. It's possible depending on how things pan out. So, all right, I'm going to wrap it up here, get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.